Please help me welcome back on stage Matthew Marshall, partner and co-founder at REdimension Capital. And together with this very capable panel, they will show us the money, or at least where it's coming from and where it's going. Please help me also welcome to the stage our panel. We have Zach George, Managing Partner, Launch Africa Partners, Khomotso Grace Legodi, Venture Partner at Grindstone Venture, and Ronald Phillips, Strategic Planning, Senior Director at Agility Logistics Parks, Proptech Angel Investor. If I could kindly ask one of our members to close the door so that we can seal the sound in. But ladies and gentlemen, that is our incredible panel. Please help me welcome to the stage, and first with a short presentation, Matthew.
Thank you very much. It's funny that capital investment into PropTech has been such a hot topic and people are looking for it. It's in this room, but everyone seems to be outside of this room. We've also been called as investors into the sector today, and I've written it down, not clever. We want to deploy capital. We want to invest capital. We've been told why we're not investing. So everyone seems to know what the issues are. But I think this is a really important session because this is really where PropTech as an industry in Africa gets its energy and growth from through capital support. So my name is Matthew Marshall. I'm a co-founder and partner at REdimension Capital. A little bit of an introduction to our business. So we are a dedicated PropTech fund manager focused on the venture capital space of the capital structure. We are in the process of aggregating capital from the real estate sector itself, predominantly in South Africa, but very much with an African focus, to be able to bridge the gap that's been discussed today around the need for PropTechs to have engagement with the sector, but also funding from the sector without some of the challenges that presents. So a couple of slides just to intro where we are today, and I think there have been some stats thrown around. So real estate as an asset class, by a long way, the biggest sector in the market by asset value, representing 42% of global assets. It's also the biggest contributor to global CO2 emissions, both in the form of embedded carbon and then operational carbon, making up 39% of global CO2 emissions. Cement alone contributes 13% to global CO2 emissions. In terms of innovation capital, there were a couple of figures thrown around in the earlier session. A shocking 0.7% of African innovation spend. That figure has halved as a proportion of innovation capital in 2021. But looking at the global trend for PropTech investment, you can see this massive growth. It is the fastest growing area of venture investment globally, and today represents 7.3% of all innovation spend. I remind you that the asset class is the biggest by some way, so this figure is still set to grow. And what are the underlying drivers of this? Well, sustainability has been a massive regulatory issue hitting the developed markets. There's legislation coming out. My partner, Peter Clark, mentioned the C40 initiatives. All office buildings over 2,000 square meters are going to have an energy efficiency certificate by the end of this year. So there are a number of pressures on the sector coming through in terms of sustainability, and the tech is just not there to deliver on those outcomes. And then the user experience. We had the REITs on this stage earlier today talking about how they are trying to keep pace with what their customers, their end users of assets are looking for in terms of a tech experience. But in the African context, PropTech lags other sectors massively. We have seen some investments, and those companies are flagged here in Egypt, Nigeria, South Africa, Morocco. I suppose, interestingly, all of these companies that are being funded are in one way or another targeting the residential sector and mainly focused on sales and letting enterprises. I've had a couple of interesting discussions today. They are targeting possibly the most difficult market to penetrate, being the residential market, highly fragmented, but clearly the biggest opportunity in terms of creating unicorns. So given the size of the opportunity for PropTech in Africa, what is required to see the funding growth that can match the size of the opportunity in this space? So I'll leave that question there and join the panel, and we can debate and discuss, and would be happy to take questions from the floor, particularly given that everyone seems to know exactly what we're looking for. Is this on? Great. Afternoon, guys. Thank you for joining me. And Zach, a special thank you to you for stepping in at the last minute. Zach, I met this morning, said, "Hi, Zach, I'm Matt Marshall, REdimension Capital. Will you join me on a panel this afternoon?" So appreciate you stepping in.
Sure.
One of our panelists had to drop off for a family emergency, so really appreciate you being here.
Sure.
Perhaps starting with some kind of macro thematics around PropTech and how you as investors in your own right, Ronald being part of a real estate corporate, but also an angel investor in your right, and Grace as a VC investor, how you perceive this opportunity in real estate and property technology, and how you go through your own approaches from a macro perspective to analyze whether the opportunity is there and the timing is right. Grace, perhaps we can start with you on that one.
Sure. Ladies first, as they always say. Thank you very much for the opportunity to be here. Good afternoon, everybody. So I guess from a macro standpoint, I think it's very important to always do a top-down approach. So take a step back and understand where the value chain is coming from. And so when you start to think about what are catalysts for growth, it's, when it comes to us as venture capitalists, many of us it's a very much a limited partner capital funnel, and that's and that's where we depend on how much investment is actually coming into VC, let alone the continent. So I think what you're finding is that also doing comparisons in terms of West versus sort of the African continent, even though it's growing, you're finding that capital is on tap on the West, and so when it comes to that standpoint, it's a lot easier to spray and pray and have a more balanced allocation across asset classes industry-wise. Whereas once you then come to Africa and there's less capital, you don't have as much of an opportunity to spray and pray. And that's that you really have to dig deep in terms of what are the most pertinent problems that need to be solved on the African continent that are scalable on a sort of continental and global aspect. And that's where sometimes you'll find the mismatch from a catalyst of lack of funding getting into PropTech is what I'm finding.
Okay, interesting. And Zach, we spoke earlier, and you suggested actually at a macro level, you see some issues with PropTech as a proposition on the African continent. I suppose interested to discuss and understand what you need to see. What are those catalytic things at a macro level that are going to get you excited about the Africa PropTech story?
Yeah, I think before that, I want to highlight that on one of the slides that you showed earlier, that you mentioned 0.7% of VC funding globally last year went to Africa. So if you break that down, Africa accounts for about almost 20% of the world's population, about 7% of the world's GDP. So there's a big arbitrage there between population and GDP. And then there's a further arbitrage between GDP and venture. So we know that the amount of risk capital flowing into Africa, by the way, the amount of VC in Africa last year was surprisingly evenly split between VCs on the continent and VCs outside the continent, which in itself is a huge milestone, given that the total amount of venture capital in Africa as little as 5 years ago was under $100 million. And today it's on track to get to about 6 billion this year. So the question here is, with the limited amount of risk capital in Africa, how do VCs allocate between the more sort of glamorous industries like fintech, e-commerce, logistics, that give you better returns in a shorter period of time versus PropTech? I get asked all the time, what is your investment thesis? How do you make decisions? And that's an entire science than just an art. But if you were to sum it down from a VC standpoint, most VCs would agree that your lifetime value of a customer or a user, be it a business or a consumer, has to be significantly higher than the cost of acquiring them. It's often called the LTV to CAC ratio. I'm oversimplifying it. But the reality is, in the Proptech industry, the LTV to CAC ratios are notoriously low, because you spend a lot of time trying to convince people to pay for something that is essentially a nice to have, not a need to have. The reason why fintech in Africa took off about 7 years ago is because you were solving real problems I mean, payments are an enabler for commerce, for transportation, for healthcare. That's why fintech has such low customer acquisition costs, because the need is so obvious. In Proptech, you're dealing with a nice-to-have solutions where your clients are usually pretty well-to-do landlords, commercial or residential. So your cost of acquiring them is high because it's a nice-to-have solution. And then the lifetime value is also historically a lot less. So you're getting screwed in both ends. So you really have to have the solution that transitions from a nice-to-have to a must-have. And that only happened recently in the West. I'm talking, when I say West, I'm broadly speaking Western Europe and North America. So it's getting that equation right is when you can start to see more funds flowing into PropTech. And there are lots of examples. I can get to that later, but that's the fundamental reason why PropTech in Africa has lagged behind other sectors.
And I don't want to paraphrase you because I think you've put that very elegantly, but I suppose we've had REITs and the more developed institutional funds up here saying PropTech is no longer a nice to have, it's becoming a necessity in their business. And that's not just to drive user experience, but they're obviously also being pressured from their investors, both locally and globally. So I suppose you saw the same dynamic play out in developed markets where there was no funding into PropTech because it had the same dynamics that you're talking about. But obviously 2015, 2016, ESG becomes a massive theme. And all of a sudden, that's catalytic to funding flowing into the sector. Interesting, just to touch on a point, you talk about market size, and interesting to talk about fintech and talking about GDP and population size. How, and perhaps Ronald, maybe a question for you, how do you think about the African market for PropTech in terms of market size vis-a-vis the US or Europe? And we've heard a lot of PropTechs talking about tackling the developed markets given the scale of those markets.
So my day job is with a real estate major. We're a large developer of industrial and logistics real estate across the Middle East and Africa. And we have a multi-billion-dollar portfolio across both regions. So we build across multiple African countries, Egypt, Nigeria, Cote d'Ivoire, Ghana, Mozambique, and we want to expand. We have problems every single day. From land acquisition, where we don't know if the title is real or fake, in construction, in procurement, in sales. We have problems every single day. And the problems are different in countries. Nigeria has a different set of problems from Mozambique. So PropTech for us, from a corporate real estate business, a B2B solution is not a nice to have. It's a must have. In Kenya, we wanted to buy a piece of land. There was a fake land title, which was owned by a fake company at the company's registrar. So if there's a solution that helps us do DD on land titles, that's a must-have. So that's the angle that we've taken. And therefore, we have looked at many B2B PropTech solutions. And then it's been interesting because there's a process of change, internal change management, to get these B2B PropTech startups solutions to work for us. Because our procurement right now is done on Excel sheets. And I brought in a B2B PropTech solution. Notion should help, but there's an entire process of change management. But I think coming back to your question on market size, the joke, is when people show me a slide in a PropTech deck that says our Africa TAM is this. And I joke, I say your TAM is a scam. Because Africa is 54 countries, and we operate in 5 out of 54. And each of these is so different. Nigeria is such a massive market by itself. But for the Nigerian PropTech founder to expand to Kenya or to Egypt, It's not easy, right? So I think when you look at market size, it's individual countries. But then I think the question is, how do they go out and capture other countries? Because I think, and Zach should weigh in from a market size point of view, if there's somebody with a Proptech solution in a smaller country, say Ghana, if he says that I'm in Ghana and Ghana's my thing, that's not a big enough market. So then he's going to show a slide with the whole of Africa, which doesn't make sense either. So then is, okay, how does he get into Nigeria? How does he get into Cote d'Ivoire? And I think that's a question that we have to figure out. How do we help them do that?
Zach, are you encouraging your investments to go cross-border?
Yeah, listen, I agree completely with Ronald on the total addressable market conundrum. It's also, there's a lot of, I wouldn't say misinformation, but there's a lot of ignorance globally outside of Africa about the true size and opportunity from an African consumer perspective. And just forgive me if I digress for a few seconds here. So if you look at the kind of businesses that were the most successful in the 80s and 90s, so pre-internet, the factors of production, land, labor, capital, going old school economics, it was always the producers of goods and services that had the power. And something very big happened in 2010, which was the birth of, which arguably was the biggest thing since the internet and mobile phones, was this concept of a sharing economy, right? There, we had the generation shift from millennials to Gen Zs, and this idea of decentralizing asset ownership, which to a lot of us just seemed like something trivial, was actually one of the biggest factors which changed the way venture capital works. So if people don't want to own assets, purely not from an economic standpoint, but from a convenience standpoint, people aren't building restaurants, they're not going to school, they're not buying cars, they're not buying houses. Because the ease and convenience and the time saved makes it a lot more viable to someone who's under 35 to just share, to lease. I mean, Airbnb, Uber, I mean, I don't need to talk to you about that. But the power has moved away from producers to consumers. Now, why is that important from an African perspective? Africa's got 1.4 billion people, which as a block is exactly the same as India and China, right? It's an important fact. Now, if you look at all the unicorns in India and China, what percentage of those unicorns do you think serve businesses outside of their countries? Take a guess. It's close to zero. China has the most unicorns after the US, and 96 or 97% of Chinese unicorns are only in China. India is marginally better. It's about close to 90%. Now, yes, Africa is 54 countries, fully agree. But the reality is, from a language perspective, we've got 3 languages, English, French, and Arabic from a business standpoint. It's important, right? We've got the B2B point. The majority of business works through telcos, retailers, banks, and insurers. And there are, broadly speaking, 4 or 5 major conglomerates across these 54 countries. So the ease of doing business in Africa is significantly higher, better than in Europe and Asia. Because all it takes for you as a founder of a Proptech startup, for example, is to sign a POC, a proof of concept or a pilot, with an MTN or a Vodacom or a Barclays or a Sanlam, and they will help you get distribution on the continent, but it has to make sense financially. So one of the mistakes that we as founders in Africa make consistently is we are so stubborn and obstinate when it comes to sharing the pie. So we would rather have a large stake of a small market than give away margin to share it with a telco or a bank or a retailer. And that's what startups in Asia and other parts of Central Southern Europe got really well. Is once you as a founder understand that you can sacrifice margin for volume, you get scale. And with 1.4 billion people in Africa that are growing quicker than anywhere else on the planet, the cost of data has dropped significantly, the amount of Africans that are online is significantly higher than it was a few years ago. It's actually a huge opportunity. So the TAM is there, provided you understand how to work with insurance companies, banks, and telcos. And you have to give something to these banks. You literally have to go to MTN, to Vodacom, to Sanlam and say, hey, I'm building this cool solution, share in my revenue with me. But too many founders are too penny wise and pound foolish. If that,
It's an interesting point, actually, and it's something that my partners and I have picked up on. But in real estate, it's slightly challenging because actually, if you look at the biggest real estate owners in the world, they've got a very small market share relative to the markets that they operate in. So South Africa, Growth Point, biggest real estate owner, very small market share in commercial real estate. So, and actually, as some of the panelists earlier would attest to, and I won't name names, corporate ownership in the real estate space can create competitive boundaries to your product distribution. It can actually stifle your growth. And I was talking to one of the Proptechs invariably targeting the residential sector, and I said, your route to market is through the banks, because your banks have 25% market share, arguably, across the big four banks. That is a route to market. To go and try and distribute your product to residential homeowners who own, I think it's 75% of the market is in the rental space. The landlord has 2 or less properties. Yep. So that's a highly fragmented market that you're trying to penetrate there. The banks, telcos, et cetera, obviously are massive distribution channels if you can partner with them in the right way. But in real estate, to partner with some of the corporates, you do end up stifling distribution, as some of the guys will attest to.
I think also, just to add, one thing that we should not neglect, and maybe it's a little bit in support to what Zach is saying. So when you think about, your banks, your retailers, your telcos, and the insurtechs that are, getting a large, pie of the fintech, of VC. Traditionally, pre the bubble of tech, or the growth of tech, I feel that property operated very much in a silo of sort of high capex, et cetera. So I think, to your point of sort of route to market, it's when you think about all these, different asset class, also I said different sectors, what do they all have in common on their financial statement? They all have property, plant, and equipment. They all need the property. So if anything, property is the life and blood of all these other sectors. And it's about how do we instill that behavioral change to really include Proptech as part of that overall ecosystem.
Couldn't agree more. I mean, we're talking to some people that absolutely would not consider themselves landlords, but if you look at their balance sheet, they are absolutely landlords.
And also, sorry, just to add to the point about the affordability and let's just call a spade a spade. If you look at the most successful Proptechs in Africa, there aren't that many, but they're getting there. Of the ones that are most successful, the ones that have done exceptionally well are the ones that are serving the lower end of the market. So for example, we're investors in a company called Dixconnect. I was talking to you earlier about how we looked at, almost 30 or 40 Proptechs in Africa, and we did only one investment. And the reason why they're doing exceptionally well along with others is because they're solving a pain point for students. Housing's a massive problem in the student market. So that is a real pain point that they're solving, but they're working with telcos, for example, to help with gathering data, obviously POPI and GDPR compliant, to make sure that they can better credit score students who historically have no credit, but they all have phones. So that's a beautiful example of a Proptech that understands how to work with the telco, right? But in this case, the telco has to benefit. So for a telco allowing their APIs access to their student SIM card information, the telco has to benefit. If the telco benefits, they give you more customers. To my point earlier, reducing your cost of customer acquisition is a holy grail in the venture world. And if you can do that by working with telcos, banks, right? Why do you think Time and Better and Bank Zero and Discovery are chasing now all of a sudden people have woken up to the 18 to 25 market? Because people know that it is highly unlikely in a place like South Africa that this part of the economy will ever become landowners or property owners because of just a mismatch in supply and demand. But they will always be effective consumers. And in the residential Proptech market, tenants and consumers are king, not landlords. And which is why it's been very hard to build PropTech that are landlord-centric, because they're fickle, they make decisions that are not often coherent and consistent, and you're ignoring the mass consumer purchasing power of tenants, commercial and residential, because you're not making it, worth their while and incentivizing. So anyway, I could go off on a tangent here, but you've got to really understand the difference between a user and a customer. Fundamental. It's VC 101, Econ 101, and the PropTech industry hasn't gotten that right yet.
Yeah, I mean, it's an interesting point. I think we are starting, certainly in the discussions that we're having, seeing corporates recognize the cost of not having technology appropriately adopted in their business. We heard a horror story about a lease that was left on a table and there was a renewal clause that wasn't triggered. It cost that property landlord 100 million rand just in the lease renewal. That just wasn't triggered because it was sitting on a desk in paper form. So some huge horror stories coming out, and invariably as the tech becomes more universally adopted, I think this acknowledgement that if you don't keep pace with the sector, invariably your product is not going to be fit for purpose for very long. I suppose moving on to a couple of other thoughts. So ESG, just lastly as a macro theme. Grace, you've just raised some money in Grindstone. It's got an SME focus, particularly on South Africa. Is there an ESG mandate to that capital? How are you thinking about the E, the S, and the G in terms of deploying that capital? Is there specifically an ESG mandate, or is it return focused? Maybe some thoughts there.
So Grindstone Ventures, for those that are not aware, it's a $10 million fund investing in, at the moment, predominantly South African tech-enabled businesses, all sort of pre-Series A, sector agnostic, with a huge focus on diversity, as well as impactful businesses that can help contribute to job growth. So in terms of the E, the S, and the G, we don't have like a specific mandate on sort of the ESG, but already sort of we have invested, in some agriculture sort of businesses and sustainability type businesses that we believe are scalable, can create jobs, and also there's a sort of a diversity lens and a gender lens to it. So yeah, that's where we are. And then I guess the only last thing to add is with Grindstone Ventures, it was born out of an accelerator. So it's one of the longest standing accelerators in South Africa, founded in 2014. I think and it's part of Knife Capital, seeing the need of a lot more hand holding within the sort of the SME startup ecosystem.
And maybe we should dwell on that. I mean, Ronald, you've spent some time coaching, counseling startups, and you see the full value chain from real estate adopter to capital allocator to counselor to some of these startups. How important is that guidance process? Is there enough of it going on in the Africa PropTech scene? And similarly around strategic capital and partnering with capital that can unlock opportunities?
So I just started angel investing a year back. And in that journey, when I was speaking to some PropTech founders, one of them, who was building a warehousing on demand startup in Kenya, said, "Can you actually help us more?" And I said, "Sure." So I'm an advisor to him. And I'm involved in his fundraising discussions, his strategy, and customer discussions too. And I think there's a big role for everyone in this audience who works in the real estate sector to get involved with a lot of these PropTech startups, because there's just so much expertise that they could leverage. So I think there's a big role for all of us in the real estate sector to get involved with these PropTech startups. I mean, there's limits to the expertise that I have. I mean, I have no expertise in valuation or trying to negotiate a term sheet with somebody like a Zach, et cetera. But at least on the business side and getting the traction, I think real estate folks can help them, and that's been my experience too.
Thank you. And perhaps thinking about angel investment, more structured investment, thinking about VC, funders of VCs, and obviously investors in your own right. What is your sense of kind of the accessibility to funding partners or funding counselors, or the access to angel investors of some of these PropTechs? Are there structures in place for very young startups to access seed capital, pre-seed capital? Zach, I read in an article that you'd provided some commentary on that actually waiting to see revenue in a startup is you're too late at that point in time. So how do these companies find you for that early stage investment, and what are you looking for when you do talk to those founders, particularly given that some of the startups have suggested that capital only comes once you have proven adoption of the product?
Yeah, listen, I get asked this question all the time, not just from a Proptech perspective. So I'll try and sort of give a Proptech angle because the audience is interested in Proptech specifically. But the reality is, as founders, you have to be the biggest believer in what you're doing. You can't expect someone else to take a bet on you without you showing skin in the game, right? So that's somewhat. I mean, when founders approach us, be them Proptech founders or fintech founders, and there's no skin in the game, clear effort, vetted effort to prove product market fit. Ultimately, the only true measure of the valuation of a startup at the early stage is validation, right? There are tons of startups that will say, "Oh gosh, I've been around for 9 months, for 2 years, for 3 years. My valuation has to go up." Or, this is the one I like and hate the most. "I've received X amount of funding from all these funds, therefore my valuation is high." The only real measure of valuation is validation. And what is validation? Validation is how do you find a gap in the market, but also how do you find a market in the gap, if that makes sense. So product market fit and a problem solution fit. Now, it is not a VC's job to go and find that for you. It's your job as a founder, your advisors, your employees, your team, right? A good VC, you're right, that's looking to make exponential returns, should be able to make a decision without a startup being profitable. If you're a Proptech founder and you approach a VC and they ask you to show, a path towards profitability within 6 months, you're talking to the wrong VC, right? What you want to see is the path to monetization, to top-line revenue, knowing very well that your unit economics will get you to profitability, right? So I fully agree that as a VC, you should understand how you can monetize users. So in the Proptech industry, profitability may not be the most important metric, but it's a question of how can you get from 100 users to 1,000 users to 10,000 users, and the marginal cost of acquiring these users gets better and better and better. And number two, once you've acquired a user, how do you incentivize them to get more users on board? So in VC speak, we call it the virality coefficient, right? Most of the most successful Proptechs in Silicon Valley have a very high virality coefficient. Airbnb perfected that model 8 years ago. And then last but not least, you've got to understand that as much as you can get a lot of users, growth at all costs is a leaky bucket. You have a lot of churn. So if you're dealing with fickle users and trying to incentivize them with freemium models where you delay gratification from a payment standpoint, people are very quick. Switching costs are at all-time highs in today's world. If you look at the amount of loyalty that people have to products, Proptech or elsewise, it is at all-time lows. We're living in a world today where brand loyalty is at an all-time low, right? I mean, think of hiring, right? A generation ago, the average number of years that someone worked at a company was between 10 to 15 years, right? In my generation, in my 20s, it used to be 6 to 7 years. What do you think it is today?
2 years.
Less than 2. It's about 18 months is the average amount of time someone between the ages of 18 and 30 stays at a company. So when brand loyalty is at all-time low and switching costs are so low, you got to think of what really incentivizes people. Can you just incentivize people by money? No, you can't. People have a lot of things that they care about. ESG, to your point, a socio-cultural fit. What is the I'm getting to outside PropTech discussions, but it's relevant in the PropTech industry because if you don't know what motivates people, you're never going to be able to hire the right people. So that's something we need to see. The PropTech industry, unfortunately, is still living in the 1980s because it's dominated by landlords and corporates who own the majority of real estate. Yeah, I mean, so, and then people are surprised, oh gosh, why are no VCs funding us? Because you're dinosaurs, right? There has been no effort made in the South African PropTech industry to cater for people under 35. I was saying this earlier, I mean, I live in I'm not from South Africa, but I moved there 12 years ago. If you walk down Sea Point Main Road, what do you think? Sea Point is owned, and this is just one example, by people over the age of 60, and the amount of ownership by young people under 35 is just unacceptable. It's probably the same thing in Sandton. A couple of families own a third of Sandton real estate. How can you innovate an industry if the power and financial control is with a microcosm of the population that live in the 1980s? It's not going to happen.
Work in progress.
Which is why you see Nigeria and Ghana and Kenya going all the way here, but South Africa is sort of flatlined.
Yeah, two more points to cover quickly, and we are running out of time. Grace,
the truth does hurt sometimes.
I'm not going to engage. Grace, we spoke the other day about the scarcity of funding to support formal venture capital, particularly in South Africa, and there's this gap between angel investors. It's really filled by the high net worths and family offices between sort of angel, seed, and private equity on the other side. What do you think is required, and perhaps focusing on a South African context, what's required to sort of drive that investment behind formal venture capital in South Africa? What do your underlying investors need to see, and what do you think maybe it's the younger generation need to see in also putting their capital behind some of this, what's perceived to be obviously higher risk investment?
Yeah, you're raising a very valid point there. So I think it's that traditionally VCs get their money from the likes of family offices / high or ultra high net worth individuals, or they get it from institutional investors and DFIs, or they would get them from corporates. And all of these names or these classes that I've just mentioned all want to see traction, etc. And that's where then there is a gap for really early stage investments. So in an ideal world, it's that you would need the younger generation where they have the mindset of being an angel investor early on of every spare cash that I take, even instead of maybe putting it into a savings account, which our savings rates in South Africa is extremely low, it's putting it in terms of building wealth and putting it into a business that resonates with them, and there's patient capital to really see these businesses do well. But you're just finding that I think a lot more, the angel investing community in South Africa is extremely nascent. And I think that's ultimately what is required, if not permanent investment vehicle structures that has that patient capital to see some of these early stages that invest through. I'm sure you can maybe testify.
To be honest, I think investment as a culture is something that we've got a lot of work to do. Last question for you, Ronald, working in a real estate corporate. What is your, and not to give away kind of the boardroom debate, but what is your view around kind of real estate corporate responsibility and driving investment into PropTech? How do you see the real estate corporate community bearing some responsibility for the lack of funding into the space?
So I think a lot of corporates in real estate, including ours, have looked at investing in innovation. And there are a few different ways you can do that. You can try and invest in PropTech venture capital funds, which we're looking at right now. You can try and do it in-house, and that's really hard. I mean, I'm quite bearish on that. But if we look at corporates investing in PropTech VCs, this is now becoming a common model around the world. So you have PropTech VCs in Europe, in the US, that have big institutional real estate players investing in them as LPs. Now, the strategic rationale is that the corporate needs to be able to pull some of those startup innovations into the corporate. And we looked at that, and we looked very deeply into the portfolios of some of the Proptech VCs, and we asked our colleagues, would you be willing to do a pilot? Would you be willing to bring these Proptech things? Because only if you say yes, will we be willing to invest as an LP into these Proptech VCs. So it's an ongoing discussion, but I think it's happening. I think it's happening at the corporates. So it's going to happen, and it's increasingly happening. So it's a good thing.
Perfect. I think we're being chased off the stage. I don't know if we have a minute for a question or two, or yeah, perhaps to the floor for a question. Brilliant. Thank you very much to the panel. I think it's been an interesting discussion, even for me. I think hopefully it was for the audience as well. Thank you very much.
Thank you.
Thanks, everyone.
Thank you.